Hey everybody, welcome to week 2 of Tom's Trading Essentials. This is a webinar series that is featured with Optionetics and Tom's Trading Room. Glad to have you guys here. I got a lot to cover with you. I have, wow, first and foremost, it is the 17-year anniversary of 9/11. Everybody I talked to has a story about where they were, what they were doing on 9/11. Mine was 9/11 was on a Tuesday, just like it is today. I was in Albuquerque, New Mexico. I was doing a 2-day Optionetics seminar. I stuck around Monday night and decided to take the flight back the next morning. My flight took off, but it landed abruptly in Oklahoma City as they forced every airline to ground. I then had one of maybe 2 rental cars left in the rental car facility because I was able to put one on reservation while still circling to land. I then went to that long trip down I-40 that took me from Albuquerque, New Mexico to the East Coast. No music that day. It was a very somber day. It was one I'll never forget. And for those of you that are U.S. citizens or not, you know, we really acknowledge those who sacrificed their lives, as well as the families who had family members that sacrificed their lives for that day. It's a day we'll always remember. Jay,
Yes, sir.
There? Can you see my screen?
I am here. I can now. You had just the black screen. We did the make presenter thing, so I see your audio box up top in the top.
Oh, I see what's happening.
And now we got a full one. We got the full one will be there. Yeah, it looks perfect now.
Good.
Thanks,
yeah,
Tom.
a little bit weird there, but it's all opened up. Everything's ready to go.
Yes.
Thank you guys all for being here. I'll get into what it is I'm going to cover with you in just a moment. Let's go ahead and go through the ground rules like we did last week. I'm going to be doing probably about an hour tonight. You know, my time, I look at my time and your time as both very valuable. So I plan on spending the hour being as valuable as I can in education and also looking at case studies. We'll be looking at 2 more live case studies tonight, at least, maybe more. All right, because I haven't done a review of last week. That's one of the things I want to do with you. So we're going to review last week very quickly. We're going to review Darknet. We're going to get into spread trading. I want to talk about taking stocks that have, oh gosh, I will show you one tonight that would cost you over $180,000, but yet we can rent that stock for the time that we want to rent it for less than 500 using spreads. I want to use examples. We'll take a couple FANG stocks. We'll look at examples on FANG, but then what I want to do is I want to create and spot opportunities of stocks that are telling us right now, at least with my tools, all right, with my systems and strategies, that there are some potential bullishness and possibly bearishness out there. So we'll take a look at that. We're going to be using the money calendar today, which is a patent pending piece of software that myself and some like-minded individuals developed. Oh, this was years ago. And so we're really excited about being able to share that with you. That's all available on tomsoptiontools.com. If you haven't checked out the free trial, check it out and you can decide what it is that you want. We'll get into that later. If you have questions, submit them in the Q&A box. I'll get to questions here and there. I'm going to pick the most popular ones because I can tell you tonight and last week, we had more people in our presentation than I ever saw in a live seminar. And we've had some live seminars where we've had in excess of 400 people in our live events. I believe, I remember being in London and we had over 400 people in our London event. Well, we've got a lot more than that are coming to us through the webinar. So again, session's being recorded. I'll get the recording to you as soon as I possibly can. Ask questions if you like. I'm going to guarantee I can't answer them all. It just isn't going to happen. And of course, the disclaimer you see on the screen, we put this up on every single webinar that we do. And basically, you can read it. All you got to do is just hit pause when I send you the recording if you want to read it from end to end. But a couple of points I want to make. Stock and options trading has large potential rewards, but also large potential risk. The other big thing I want to mention is that myself, Jay, everyone associated with Optionetics and Tom's Trading Room, We are here as your educators. We are not brokers. We don't give specific trading advice. You need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in US dollars unless noted otherwise. All right. Again, I want to welcome back all of our Optionetics students and those of you that are brand new with us. Hey, you found me. All right. Or maybe I found you, or maybe it was a little bit in between. If you're new to Tom's Trading Room, if you go to optionx.com, this is what you're going to see now on the screen. And it gives you some interesting information, whether you're new to the trading room, whether you're a returning Optionx student, whether you use Platinum. If you used Platinum in the past, all right, Tom's Option Tools is a major upgrade to Platinum. And you can get a free trial just by going into www.tomsoptiontools.com. And then, of course, a little bit about me for the few of you who don't know me. All right, today we're going to go into really a review of week one, all about spreads and trading what I call the money patterns. All right, but more in particular, we're going to talk about money calendar. Next week, I'm going to get into reviews of weeks 1 and 2, more case studies, and then I'm going to talk about how to trade like a professional trader. All right, how to make this instead of like a side hustle, to make this a business, because that's where I want you to be. I want you to be as a trader, be there as a business. I take, someone was asking me, how many trades do you do? Really? Maybe one or two a day. I mean, I can look at dozens of trades that meet different parameters. I probably could look at 100 trades if I really looked at every single, tool in my war chest of trading, and I'll pick the best trade for that day. And it allows me to go in and take a rules-based trade, but then what it does is it allows me to diversify by time. So a trade today, a trade or two today, a trade or two tomorrow, a trade or two on Wednesday. And of course, there's only a certain amount that I will invest in each trade. And that's what options allow us to do, is to get into these trades and get into the rent side instead of the own side for much, much cheaper. But we'll get into that next week. So if I were to do a quick review of week one, what did we talk about? We talked about all about calls. We talked about all about puts. We went in and looked at a couple of different strategies and systems. And my favorite trade last week that I gave out to everybody was Coca-Cola. All right. And I gave you full disclosure that I took that trade in Coca-Cola that I did. All right. So what was that trade in Coca-Cola? Let's go ahead and look at it. So I'm going to get to this in a moment. So here I am. I'm at tomsoptiontools.com. And once I've logged in, I have all kinds of different things I can do. Option trader, contrarian trader is where we were last week, and I'm going to get back into that shortly. But we're going to go into the part of the complete trader, which includes the money calendar, and we'll look at what the money calendar is telling us, which is coming up over the next couple of weeks. All right, the rest of September, by the way. Before I do that, though, I want to mention Coke. So we went in and I looked at stock charts, and I already kind of pre-populated this just to have it ready to show to everyone. So here's KO. This is Coca-Cola last week. So last week we had Coke, and this was the 4th of September. I want to show you, because I can do all kinds of things with the stock charts. We've got stock chart peaks on here showing highs and support and resistance pieces. These are not your typical support resistance. We look for support resistance off the close of the day, which is why some of these aren't exactly at the tippy top high or the bottom. But what I want to do is over here by chart type. Instead of stock, I want to come down to darknet, because we are going to do a review of darknet at the same time that we're reviewing calls and puts. And if you remember last week, I got a darknet buy the day of the webinar. So I took a trade in darknet. What did I do? Well, I went from this point here and I looked and I said, Coca's had a history of when it hits a buy signal, has a nice move up to a sell. Now, this is about a 2.5 point move that we saw the last time, from 42.5 to 45. Currently, I get a buy signal right at 44.5. Okay. So I go over to the stock and option table, and I'm looking at all these particular option expiration. Now, keep in mind that darknet is typically about a 20 plus or minus trading strategy, about a month roughly, right? I'm looking at September 21st because I know that one has the most strikes. I know it's the most liquid, and we got to go out to October, 19th to get to the next third Friday. And that's just too much time. So I thought what I'll do is I'll stay in the September area. I'll go with September 21st. And I went ahead and clicked on that. And this is on the 4th of last week. I'm updating. I'm scrolling down and I see all my call options on the left. I see my puts on the right. And I know I can buy the 44.76. I can buy the 45 call. It's only 28 cents, but it has no time. It has no real value. It just has time. So if Coke just sat in the level of 44.76, slowly that would drop in value. All right. When I buy call options, what I like to look for is I like to look for value. I like to look for a delta on the call to be at least a 70. So this is the, if you see here, the delta. All right, if you see the line that comes down here, just to the right, I've got the options delta. Now a delta, for those of you that need a refresher, an option delta is just the percentage that the stock price is going to move relative to the stock. I like that to be around 70 or greater. So I don't have to go too far. 44.5 has a 59 delta. The 44 call has a 74 delta. There we go. So I'm coming in here and I'm thinking, all right, let's buy a few contracts of that. So I type in the contracts that I want because I want to look at the risk graph of that particular trade. And it's going to show me, first it's going to show me that these calls on that day were bid at 90 and offered at 92. Now I actually ended up getting filled at 91, which is right dead in the center, which, you know, sometimes does happen. And so I put a limit order in. That meant that I was going to buy them at 91 cents or better. And I was playing around with the last, I don't know, half hour a day. And sure enough, I got filled. So I'm in at 91 cents per contract. Now, if I did 20 contracts, it's going to cost me, you can see, $1,820 for the cost and the risk. All right. Now, because this is so close together, I don't have a lot of slippage. This is a very efficient trade. The other thing I have is I have unlimited profit potential, but that's really, to me, that's kind of like a hoax. All right. You don't really have unlimited profit potential. You're limited. It's really great upside until expiration or until you get out of the trade. Because like I said last week, you could do three things with an option. You can sell it after you buy it. You could sell it to someone else, hopefully capture a profit. You could exercise the option and take the stock. Sometimes people do that for tax reasons, or if it just basically falls apart and isn't worth anything, you just let it expire worthless. So this particular trade, I'm going to back up and I want to show you, for those of you that haven't seen, this is what ended up happening with Coke. All right. So Coke ended up, and what I can do is I can actually go and I put this in backtest mode so I can show you what happened as of last week. So this was last Tuesday. Here's Wednesday. All right. Wow, big move up. This was a great day for that trade to generate some dollars. If you take a look at the trade itself, all right, let me get to the risk graph. So if you take a look at the trade itself, look what happened a day later. We know the stock went up. The options were up over $1,000. They were up 60% one day later. Fantastic. Let's go back and see what happened the next day. So I'm going to plus a day. Now we're on the 6th of September. Another big move up. All right. Did we get the double? Let's look and see. Plus a day on the options and 97%. By the way, that did double that day. It just pulled back. All right. But if we keep going, plus a day, here's 9.7, 92%. Plus a day, here's 9.10, 128%. So if you missed it the first day, you got to capture that gain by the 10th. Okay. That was yesterday. So you can see what it is that happened with Coca-Cola. Right. Out of half when it doubles in value is a great rule to follow with any, pretty much any strategy involving stocks. ETFs, I'm a little more conservative, but with stocks, that's what I like to follow along. What did I do? I spotted the opportunity using Darknet. I created a low risk trade with these call options on Coca-Cola, and it's just a matter of planning, executing, and managing the trade. Planning is just putting it in ahead of time. Executing it should do it on its own. And then managing it means put your exit orders in ahead of time, because I'm too busy to sit there and look at the markets all day long. I got things to do, all right? And so some things I want to do that involve me leaving the office. So there you go. That's Coca-Cola. I had a couple of other ones that I was doing during the week. So, I mean, I'm happy to share those with you. I was kind of in that theory last week because of Darknet. Darknet was showing me what about Philip Morris? All right, so let's look at Philip Morris. Now, Philip Morris had a buy signal. Now, keep in mind, we're looking at 9.6. I'm going to bring this up to the latest day so you can see what happened. So last week I had a buy signal on Philip Morris. This went up. I got out of half of it and doubled in value. It was a good thing too because it's dropped since then. All right. How about Merck? That was another one that I got involved in. MRK. These were three just last week that were based on Darknet signals. Up, and then it too reverted and came back down. Now this one has not doubled in value yet. It almost did, but then it pulled back. So I'm still looking for that to flourish, if you want to call it that. All right. But again, that was using the Darknet stock strategy that we have, which is very similar to Elliott Wave. However, I believe it's simpler to use because we're not looking at wave counts. We're not looking at pullback. We're waiting for the Darknet design, which is all built in to give us that bullish B, all right, to give us that ability to start looking further into that stock. If you look at Darknet today, let's do that right now. So from Tom's Tools, I'm going to go right to the Darknet channels. Let's see what Darknet's giving us for today. So Darknet is giving us a lot of stocks. I mean, there's a bunch of them here. From this point, what we can do is we can go in and we can look at things. Noble Energy. And so if you click on it, the chart will automatically pop up so you can see, well, Noble had a buy and a rebuy and a sell. That was a winner. There was a buy and a sell. That was a small winner. Here's the buy today. It's already moving in the right direction. This is a lot of stocks for me, though. I want to trim that list down. So instead of all Darknet stocks, I can go to a list that I've already created that is called pennies and weeklies. I showed you how to do that last week. Now I can look at things like OIH, which is more liquid, right? I didn't like oil. I didn't like this because, my outlook on oil is that we're going to ease off. In fact, I believe the reason oil moved up today. Wait, I'm going to ask the question. I want to ask the question to you. Let me just check and see what's going on in the Q&A box here first. All I hear is music. Do I advise limit orders when I place my trade? Yeah, Tom, you know what? I do because, the worst that happens if you don't get filled on a limit is you just lose an opportunity. Opportunities in the market come every day, all right, if you have the right strategy. Now, I see people buzzing in real quick on why oil is going up. Please answer with your one-word answer. Why is this oil market going higher? Mike, you are correct. James, you're correct. Pete, you're correct. Larry, correct. Richard, correct. Alan, you guys are all correct, all right? Lewis, Chip, Brian, Tiffany. Yeah, Tiffany, that might be one of them, but we're looking at hurricane. That's what everybody else is coming in. Ted, and the list just goes on and on and on, all right? And so that's it, okay? Is Darknet, and another question is Darknet a tool? Yes, it is. It's a tool that we have created over several years to try to simplify a contrarian trading strategy. What Darknet incorporates is multiple channels. When you put multiple channels on a stock, we're looking for buying opportunities on multiple channels. Darknet was featured a few years ago in Stocks and Commodities magazine. It was on a feature cover on Stocks and Commodities magazine, and it has if you look at all the Darknet stocks, has a really high rate of success. When you look at all the stocks over, we did I believe it was a 5-year back test at the time. So and again, it's all based on looking at the contrarian form where we see a pullback. And then what I do is I just look a little bit deeper. What I do is I'm looking at this chart. You see this chart here on OIH? Where are we today? If we're somewhere near the lowest part of this chart, I'm going to skip it. I think we can find better opportunities. Halliburton, Baidu, JP Morgan, ding, ding, ding. By the way, full disclosure, I have a trade on today on JP Morgan based on that chart right there, okay? Move along. I got something else I put. Oh, yeah, let me show you what else I did. So FAS, This is actually an interesting one. This is the daily, the Rexon Financial Bull. It's a power share. I'm not a big fan of these buying options on them, so I skipped that one even though the chart looks pretty good. EWY. Okay, now I've done this one in the past, the MSCI South Korea Index, but I don't like where the chart is. It's down near the low. I know the adage is buy low and sell high. I like the buy high and sell higher adage that William O'Neill presented long ago. Take a look at HLF, Herbalife. What do you think of that one? That was another one, full disclosure, that I took an options trade on today. Okay, so you can see it's got that classic higher low, higher high. Earnings report, every one of these E's with the triangle that's pointed up means that they met or exceeded their earnings expectation. And look at the stock, it jumped off of these earnings reports each time. So last buy and rebuy and sell were profitable. So now we have a buy in here now. And I'm looking at this one at just above $54.54. I think it's going to take out that $60 high. And I think we could be potentially 8 points higher than we are now. Right? So I've put myself in position to capture some profits based on HLF. Now, what did I do? All right, I simply looked in that plus or minus roughly 30 days out, and I bought call options that are what? 70 delta or better as far as that delta is concerned. I want something that's slightly in the money. It's a very easy system, guys. All right, it just really is. I mean, it's just something that we look at. And the thing is that whatever system or strategy you use, you've got to buy onto it yourself. All right, don't just listen to me. Find out for yourself whether it's something that you feel like you can wrap your arms around. Whether it's whether you're buying. We did a thing last week called buy the highs. And buy the highs is a great strategy because it gets you in stocks that are making new highs, even when the stock market could be making lows. All right. So let me just throw a couple do a little bit more Q&A here. How do I know what type of chart I'm going to consider? And Brenda, what I do is, like you see here, when it is, when it's questionable and I have all these things to pick from, I'm going to pick from the best. Let me show you Juniper. This is one I did not get into, but I like it. I like it because it's also doing the higher low, higher high strategy. Now, that little earnings report where we backed off, that might have been the earnings were high, but the outlook is not so high. But we did regain and made new highs after that earnings report, and then we did a little pullback. And that could be telling us that it might be time to jump back in again. All right. Thompson, didn't I buy a vertical? No, I didn't. I did not buy a vertical for Coca-Cola. The call options were cheap enough. There was no reason to do a vertical or what we call a loophole spread. I'm going to talk about loophole spreads here very, very soon. All right. Do I adjust a trade? That's that's a tricky one because to me, adjusting a trade is if you've got a longer term outlook. Let's say you got a 90-day outlook on something and you buy 30-day call options. Well, 30 days later, you still may have 60 days left in that particular trade. So you might want to roll out, or maybe you buy the long-term options and maybe you sell short-term against it. It's called a diagonal. That's the way we could be looking at adjustments. All right, what's the difference between green and yellow symbols on the darknet? Good question, Thompson. Excellent question. Do you see some of these are green, some of these are orange? This doesn't mean that Noble Energy is the best and Juniper is the worst. What it means is what happened to that stock during that day. So if I were to get a little bit, once again, look at NE. I'm going to click on NE. Here's a chart for NE. Now, it might be hard to see it here. Let's see if I can just blow that up. All right. Can you see that the stock went up that day? So it painted it green because it had such a good day. Now look at Juniper. Now when I bring Juniper up, it actually ended lower than it started. So it had not such a good day. Right? It's just showing you what's happening for that particular day. By the way, here was a stop signal, which means time to think about getting out. This was MBI or MBIA. This one right here, again, it's a pass for me because it's a cheap stock, $7, $8, $9, $10, $11 stock. So you don't get that much of a move. the last symbol or the last signal was at, let's call it $10.25, and it went to $11.25, or no, excuse me, $10.75. So that's a 50-cent move. A 50-cent move on a $10 stock, that's 5%. That's pretty good. But 50 cents is 50 cents. I think I can spend my money and my commission dollars a little bit better on a higher dollar stock that has a good bit of movement to it. All right. So, and then Bruce is asking, what did I do on HLF? Well, I mean, HLF, I can walk you through it real quick. All right. But what I'm doing is, as you can see here, is a buy signal. So what I'll do is I'll go and I'll look at the options on HLF. So I'll go to option chains. All right, you can see HLF is already picked. So what I'm looking at is, in this particular case, I can look, the most important ones that I'm looking at is the September 21st and maybe the October 19th. So we'll take a look at each. All right, the SEP 21s, there's the $54, that's $1.24. That's a 59 delta. All right, I had to get to the 53s if I wanted to buy something that had a 73 delta. But it might not have enough time to expiration. So I went out and looked at, guess what? The Octobers. Look at the October 50 calls. All right. October 50 calls are 505 by 525. Now, in this case, a little bit above my $5 by $5 trade. Okay. So what I do is I put an order in, and I'll put an order in for $5. So in the event that it comes down, and it did, and it comes down to that level, I can get filled. That represents that 81 delta, means that 81% of this trade is real value, and only less than 20% of the trade is actual time value. That's a good, really just a simplified way of understanding what a delta is on the option itself. Okay, so let's get going. I'm going to move forward with everyone. We talked about a review. We talked about darknet signals. We looked at darknet signals for today. Let's talk about spreads. So I want to spend a little bit of time with you talking about spreads and why spreads might make sense with certain stocks. All right. And when I get to an end here, I'll take some more questions. If you have questions on spreads, now's the time to be thinking about those, as we'll be discussing trading spreads here over the next few minutes. And then I want to talk about money calendar. So we know calls give us the right to buy and puts give us the right to sell. But when you combine two calls or you combine two puts together, you're actually using one to help finance that particular trade. So the first question I want to ask and answer is, what are spread options and why do we trade them? So bull call spreads, you'll hear that coming out of my mouth quite a bit, as it has for decades now, involve trading more than one option simultaneously. And what that does is that allows you to lower your overall cost of your trade, lower the overall risk of the trade, lower the fluctuation, which is going to lower your stress, all right? Because if you're in a trade, and you're going to see what I'm talking about here in a moment, and it costs you too much, you're going to do the wrong thing. It's a given. Warren Buffett was characterized by saying that greed makes you do things you shouldn't, and fear keeps you from doing the things that you should. And I wholeheartedly agree. This is one way to reduce both greed and fear in the markets if you want to play with the big boys and trade big dollar stocks on a small dollar account, okay? So that's what bull call spreads will do for you. Let's move on. I'll show you what I'm talking about. So this is just an example. I'm going to use XYZ. Then we're going to actually look at real trading examples. So buying a 100 call, let's say that cost you $10, but if you sold the 120 call, the 120 call could bring in 5. All right, so you're buying the lower, you're selling the higher. The lower strike call, the 100 call, is going to be closer to where the stock price is. Maybe the stock price is trading at 100 right now. Maybe the one that's out of the money, that 120 call, is trading for less money than the 100 call is, and that's what you do to create the spread. What you're doing is you're using the 120 call that you're selling to help pay for the 100 call that you're buying. Debit spreads will always cost you money, but much less in some cases than outright buying the call option. Now, when I buy the 100 call and I sell the 120 call, that's what I refer to as buying the 100-120 call spread. And if one cost me 10 and one cost me 5, then 10 minus 5 is 5. That's what my cost is going to be on that overall spread. Okay, so this is what it would look like if you were to put this on a risk graph and draw up your risk and reward. So if the stock price is at 100, let's say this down here to the left is closer to 0. Let's say up here to the right is closer to 150. If we're in the area where you buy XYZ 100 calls, that means that you have the right to buy XYZ at 100. Okay, that's your right. But if you're selling a call option, you are obligated to deliver that stock at that strike price if someone wants to claim it or exercise it. Okay, but by buying this together, you eliminate the risk of the 120 call that you've sold. So if I buy the XYZ 100 call, let's say I pay $10 for that, and I sell the 120 call for $5, my entire cost and risk is going to be $500. If XYZ goes to 50, well, both of these are going to expire worthless, but I have a $500 risk instead of a much higher risk if I just bought the calls. On the other side, if they go up, and let's say XYZ jumps to 150, both the 100 call and the 120 call are going to go up in value. But when you look at the difference between what the 100 calls worth and the 120 calls worth, they can spread out to a maximum amount of profit, which is equal to the distance between the strikes minus what you paid for it. So 100, 120 could spread out to be 20 points wide. If you paid $500 for it, that means, or $5 minus 20 is $1,500 per contract. That's your maximum reward on a spread. Now let's look at this again with a couple of different traders. So let's say that XYZ is trading at 100 and stock goes from 100 to 120. You got 3 traders here. One buys 100 shares of stock for $100. Trader B buys the 100 call for 10. Trader C buys the 100 120 for 5. All right. So let's take a look at what these are going to cost these folks. So Trader A has a cost and risk of $10,000. Now, if Trader A decides they're going to put a sell order in at 120, then they could make $2,000 or a 20% reward. If Trader B buys the call option for 10, at 120, your 100 calls worth 20. You paid 10. That means you doubled your money. You made 10. You made 100% return or $1,000. Trader C paid less than all 3 traders, made more than Trader B, made less than Trader C, but when you look at the return on investment, Trader C had a 300% return. Now, that's the good news. Let's take a look and say, I'm sure somebody's out there going, well, yeah, but what if it goes down? Okay, let's see, what if it goes down? Let's say that it goes from 100 to 50. Remember Trader A bought 100 shares for $100? Well, they lost $5,000 because the stock got cut in half. How about Trader B? Trader B loses what they paid for the call option, which is $1,000. Trader C loses what they paid for the spread, which is $500. So everybody lost money. Who lost the least? Trader C. Trader C did lose everything, but on a contract by contract basis, you can see here that the silver lining still lies with Trader C. Now, put spreads are just like call spreads. So put spreads we use in bearish opportunities when options are expensive and when stocks, you expect the stock market to drop or a particular stock to drop. You buy the higher strike put and you sell the lower strike put using the same expiration date on the same stock or ETF. And it does, like call spreads, give you lower cost, higher reward, and a higher profit potential. Now, choosing the perfect spread trade, this is where I want to go in and I want to do a couple of things. So I can tell you right now, FANG stocks are not cheap. FANG stocks are great stocks to be looking at this on if you are bullish or bearish on a FANG stock. So let's just throw some out here. Now, let me make this perfectly clear. I only have one position on a FANG stock right now, and that's Apple. And I have a spread on Apple. But everything I'm going to show you in FANG is just examples of how to have lower risk. These are not bullish or bearish case studies that I'm about to show you, i.e., you do your own homework on these, because I'm only showing you these to really instill the fact that spreads can cost a lot less than the actual underlying. So let's go back to the tools. I'm going to go back to Tom's Tools, and I'm going to go to a stock chart. All right, let's take a look at Amazon. I want to look at Amazon because it's the biggest FANG stock. That's the one we look at. All right, so Amazon had a big day today. If you guys don't realize, it had an outside day. An outside day for most people who are technicians means that the market may have had a turnaround. Now, if you look what happened, Amazon opened at 1928 and it closed at 1987. That was a big, big move. Count them off with me. It's 28, 38, 48, 58, 68, 78, 88. 60-point move today. 60-point move. All right, that's a big move. But I can tell you something else is that there's very few people that I know that are going to just go out there and buy call options on Amazon. They're just too expensive. Let me show you what I'm talking about. Let's say that you have a 2-week outlook on Amazon right now, and you're looking at that those September 19th options. Let's go see how cheap those really are. So if I go to option chains, and I go out here and I'm looking at not this week's, not next week's, but next week's, the September 21st, 10 days from now. This is a short-term move, all right? And let's just say that I'm just looking 5% above and below where the stock price is right now. Now I'm going to come down. 5% still is a lot of strikes. All right, so take a look at what the at-the-money calls are trading for with 10 days to expiration. Going to cost you $34.05. For this option. I'm going to throw the risk graph up here because you need to see this. You really got to see this. This is showing you now when a person first looks at the risk graph and they see, wow, that's my risk, but this is my reward for $35,000. Yeah, if it gets to $2,385 in 10 days, sure, you can make that much money. But look what you're risking. You're risking $3,405 first of all. But you know what you need to look at? You need to look inside the area that's the red area, because that's the statistical range that the stock should be in the next 10 days. And that's even really high hopes that happens. So if I were to take the distance, and let's call it 1900 to 2070. So I'm going to come down here and I'm going to change my lower to 1900 and my upper to 2070. And I'm going to reset the graph. All I'm doing is I'm giving you binoculars to look closer into what's going on. Now what we're doing is we can see that we're still risking the 34.05, but if we get to the top of the graph here, what's it going to potentially make us? Only $1,500 in the next 10 days. How about the next, with 4 days to expiration? I could make about 2,100. What about 7 days to expiration, 2,500. We still haven't made as much as we're risking. What about over here? What if it goes up in 1 day? How much can I make? $3,126, still less than the $3,400 out there. So a couple things I'm looking at. Number one is that if you've ever bought an option and the stock went in your direction and you still lost money, you know exactly what this risk graph is. You know exactly what's going on here. Time is eating away faster than the stock can go in your favor, and that can happen. All right. One way to combat that, to combat the price, combat the time, is to look at a spread. So let's go back again and let's look at this in a different way. We're going to buy the lower. Let's just stick with the 1987 calls, and let's go ahead and buy the higher. And the higher we may buy is, how about the 1987 and a half, 1997 and a half? All right, so we're going to sell that call. So buy the lower, sell the higher strike, create that bull call spread. Let's click on the risk graph. Now to do the bull call spread, $507. Fantastic. To make what? I mean, it does look like a 1-to-1. If you put a limit order at 500 in, you're risking 500 to make 500. But look, the stock doesn't have to go anywhere. It barely has to move. Let's take a look. It just has to go up, what, all of 10 points. So, and it did 60 today. So it can be capable of doing 10 points in an hour. Let's fix this again. What did we have? 1900, and we had 2070 as our window of opportunity. Now take a look at the risk graph when I change the numbers. Now look at this. There's your total maximum risk. Basically $500. Call it $507 to be exact. Here's your total reward, a little less than $500. But look at this. All you have to do to get the maximum reward is just get up to here, a little bit more. You just have to get up to what level? You have to get up to that 1997 half level, which is where you sold those options. If you're at or above that in 10 days, you bank 100%. Again, let's go back to the call option that we had before. We couldn't get to 100%, even if the stock got up to 2070. All right, you've got an area here where you're risking 34. Oh no, I'm sorry, I was looking at the blue line. You'd have to get, in order to get to double your risk using the call option, you've got to go 34 points. You've actually got to go 68 points above where you are right now. So you add 68 to 1987.50, and there would be your double. So 68 points or 10. I like 10. 10's a much more doable number. 10 from where we are right now, not 68. Okay, so we actually, this is a very good example of exactly how spreads work. And I could go back to the option tables and I could look at Facebook. All right, let's throw Facebook in there. Facebook's not a high dollar stock, 165. And you know what? To me, Facebook's heading lower. Facebook is not, if anything, Facebook would be a great hedge to the FANG stocks, because I do believe that, if you look at fundamentals, nobody really trusts Facebook like they used to. There's a lot of people taking a Facebook break. This is all not good for earnings, because advertisers are going to see this, and a lot of advertisers are getting kicked out because of their messages, and so that's going to hurt advertising revenue for Facebook too. So what I could look at with Facebook is I could go out and let's do not the one with 3 days to expiration. Maybe I go out to October 19th. Okay. Maybe I'm looking at Facebook and I'm thinking, you know what? How about the October 19, 165, buy the higher strike put, sell the lower strike put. I want to put something bearish on. Let's look at a risk graph on this. So this is $182 for the spread. All right, because I could have bought the 165 puts. They would have cost me almost $5, but by doing the put spread, it's only going to cost me, it looks like, less than half. Less than half for the spread. That means I don't have to go that far to have this thing right as a stock. If the stock were to drop down, even drop down to the lows that we were at just a few days ago, we're in the profit zone. All right. Now, make no mistake about it. I don't have with Darknet, and I don't have with Money Calendar bullish or bearishness on any of the FANG stocks right now, except Apple. Apple does have a bullish trade on, and in fact, again, full disclosure, I have a spread on Apple. I've had a spread on Apple for a couple of weeks now. It is way in the money, right? Which brings me to the next question. If you have a spread and it's actually doing really well, it's gone up and it's up here, and you own the strike, the much lower, what's your chance of assignment? Well, your chance of assignment could actually be pretty good. But that's okay, because you own the lower strike. If you get assigned on the higher strike, you simply exercise your lower strike, and that carries away your risk of assignment. Guess what else it does? It gives you the full profit potential without commissions. I'll say that again. The only way to get a maximum profit on a spread is to let it go into expiration and have it auto-assign, auto-exercise, or someone else assigns you on the short options, and then you simply exercise your long. That is how you get a maximum reward on a spread. Okay. If spreads are confusing to you, my suggestion is you start to try them out and work through them on your own. I'm going to show you another spread right now. I'm going to show you potentially two that I am interested in. One of those I really like, and I'm going to show you those right now. But it involves using something that I want to share with you right now called the money calendar. Because for me, when it comes to my trades, it's always about spotting opportunity first. Okay. If you lost money in the stock market, I've said this before, and a lot of guys have picked up on this, so they've been using this quote. This is my quote. All right. When I quote somebody, I'm happy to share who I quote from, whether it's Warren Buffett, whether it's Larry McMillan or Jake Bernstein, or a lot of the guys that I follow and that mentored me early in my career as a trader. Jeff Hirsch over at Stock Traders Almanac. But here's one from me. All right, if you have lost money in the stock market before and you currently lose money trading stocks, and you think options are going to solve your problem, they're not. All options are going to do with your losing stock system is allow you to lose money slower. That's it. So perhaps you need to learn a different way of spotting opportunity. I like to spot opportunity, create the low risk trade plan, execute and manage the trade. So we're going to do that right now with something brand new that some of you are just seeing for the first time. So back when I parted ways with Charles Schwab, mutual parting of the ways. We parted as friends. All right. I think I remember saying, it's not you, it's me. Can we just be friends? I'd like to see other people. That's what I did. And they said, oh, it's okay. It's not you, it's us. Anyway, we had a good parting. I still talk to a lot of the guys over there on a regular basis. And like I said, it's a very good friendship. But after that, I kind of took a little sabbatical, and I started working on something that I'd shelved a long time ago. And one of the guys at a rival brokerage firm named TradeStation, who I'd known since the 90s, helped me take something in design and put it to a real computer project called the money counter. So the money counter is basically something like seasonality, but we take it one step further, or a lot of steps further. We take seasonality down to the single stock, not a commodity, or not something like the buy in May and go away, the oil patterns that may happen, orange juice goes up when it gets cold in the winter. We went and we utilized just some of the biggest computers that we could find that would go through billions of short-term patterns and data points each and every day, actually, not every week. And we use 10 years of historical data. And from there, what I do is I then go in and I start looking for these option trades. That's to create the low-risk trade portion. This is something that's so valuable that I'm in the process of getting a utility patent for it. It's that good. It's that important to me. So this is what the monthly view looks like. So what the monthly view does is it shows me, out of all the stocks out there, the optionable stocks, and there's probably about 4,000 of them, roughly about 1% of them on average make the money calendar on a day-by-day basis. So if you take a look here on this particular day, we had a total of 48 stocks. 20 of them were bullish and 28 were bearish on that particular day. Now come down here to the 31st of this month. There were 128 stocks. 96% of them were bullish. Now, in order to make that day, you have to have a 90 to 100% accuracy going back 10 years. So what I'll do is I'll go from there off, and on a particular day, I'll click on it, and it'll take me to the day view. And on this particular day, I see Priceline up here, PCLN. And I see that, it's net profit. I see its accuracy in the last 10 years. It's worked 100% of the time. It's average profit. The end date, I got the beginning date. I got the end date. I've got the average profit. So, as an option trader, that's all the information I need. That really, to me, is like that big mystery unveiled. Option traders, stock traders, all they got to worry about is price. Option traders got to worry about price, got to worry about time, got to worry about volatility. All right. The money calendar takes care of two of those three issues right off the bat. Gives you the average price move, gives you the time that pattern's best to be taken for an entry and exit. Then it's just a matter of looking at the volatility, and that will help you determine what the best option trade is to do. Right? So here's Priceline, and here it is. It's a 30-day trade. The buy was on January 8th. The stock price movement was bullish. We knew it was going to go out to mid-February. And so I look at the pattern and I go, oh, the last 10 years all look good. But boy, those last 5 years were really good. We were popping 100 points during the pattern 4 of the last 5 years. Must do this. So we look out and we start to create that low risk trade. And this is where buying the lower and selling the higher strike option makes sense. All right, in this case, we were looking at the February 1590 1600 call spread. Buy the lower, sell the higher. All right, the lower one was costing $17.15. The higher was being sold for $13.95. We're talking about something that had about $3.20 difference between the two. A 10-point spread that you could do for $3.20. That $3.20 equates out to $320. That's your debit, that's your risk. Here's your maximum gain on a trade like that, $680, or a 212% maximum profit to maximum risk scenario. By the way, the stock increased 5.37% during this particular pattern. And of course, the options doubled and even tripled in value. So let's do some case studies. Let's look at the money calendar for real right now so you can kind of get an idea. What I do is I look at the monthly view, I look at a daily view, and I try to go from there and pick what I think are some of the best picks based on patterns that repeat themselves over and over again. So first thing we're going to do is we're going to look at that money calendar for September. I want to show you something. We've been doing this with our professional traders. So we do live webinars every day, Monday through Thursday each week for our pro group. And this is live with the markets, and we're picking case studies. And so Monday we were talking. Monday was yesterday. So yesterday I was talking about Apple as a short-term trade because we saw a pattern in Apple. But I also look at the monthly on the money calendar. This is the monthly for September. Now here's where we are. We are September 11th. We are in near the tail end of this just nice long bull run we've had that started around the end of July, all right? Really mid-July, from mid-July to mid-September, and we took full advantage of that, those of us that use this particular piece of software, because we're going through, end of July, and we're seeing all these trades that are popping up, and we're seeing URI, by the way, which has just gone absolutely bananas to the upside. All right, UNH is on this thing too. Applied Materials was, I'm just showing you some stuff that was back on August 27th. Just amazing. Here's Philip Morris down here at near the bottom. All right, Southwest Airlines, fantastic. All right, that one has done really well. I think it's the options, the at-the-money options on that got to be up about 35% so far. Walmart's on here too. If you haven't taken a look at Walmart, it's gone very, very well. Micron Technology has been a darling, all right? Has pulled back recently, but was a darling over the last couple of weeks. And the list just goes on and on. But I'm going to go back to the month. This is August, by the way. And so you can see where August started was really the 17th. And we saw the money calendar saying, get bullish. Start looking at leaning into the bull side. This is what I talked about, and I actually talked about it not only to our professional group, I even did videos. And those of you that follow us, we've got a YouTube channel, Tom's Trading Room. Those of you that subscribe to that, you heard me back in mid-August saying, this is where I'm going to lean into the bull side, all right? During this time period, I had the best moves in my portfolio all year long because of all this stacking that was happening, bull after bull after bull. Okay, so guess what? Easy money looks like it's gone now, because here we are in September of 2018, and we are in the tail end of what's going to happen is the next week. What we're seeing is patterns that are reversing themselves, and that means that we're going to see more bearishness than bullishness. It's not going to last long, a couple of weeks. This could be a good time to just get to the sidelines. It could be a good time that if you're looking at trades, you want to be tighter on your bid asks, because guess what? Once we get into October, and see, the guys on television, they all throw out comments they have no reason to throw out. Like, oh, September and October are the worst months of the year. They're not looking at this, because over the last 10 years, which to me is the pattern to look at, we go from about mid-September. As you can see here, we go about mid-September, we get a couple weeks. Then we pop in October, and we start heading higher. And what's happened is September tends to be more of the most bearish month. And October, the bearishness is really ending by mid-October. And then all of a sudden it's a race to holidays. And then all of a sudden retail stocks get exciting again. I think Apple is just going to really shine this year. And so, as long as the tariffs don't hurt them, and I don't think they're going to, then tariffs may account for a 1% difference in their profit going forward. The current tariffs as we see now. But I think Apple is going to be that safe haven, especially if FANG stocks start to take it on the chin again. I think a lot of money is going to steer itself right back into Apple. It's become the darling again, but it's also become the darling of traders, not just the darling of investors. All right, I'm talking too much. Let's get into some stocks. So September 11th. All right, I see a lot of bulls on here. Well, how do I know which ones are the best? Over here, I got net profit. I've got the accuracy over the last 10 years. Take a look at this. These are all trades that over 10 years have been 100% accurate all the way down. There's a couple of bears on here, all right? But are they the best? Well, the average profit per year, if I get the biggest average profits, that might be the best ones. But are they? Are they the best? Okay. You know what works for us? We have a trend. We have a particular trend indicator we use called power meter. And when I double click power meter, I'm looking at something that has the highest power meter because it tells me the trend is coming in. Take a look at this stock. This used to be Priceline.com. It's called Booking now, BKNG. And when you look at Booking, I see that it has a buy from September 11th to September 20th. That's not a long time. So this is more of an aggressive trade. All right, it's an aggressive trade. But take a look at this. All right, you've got an 8-day trade. These are 8 trading days, by the way. Average trade was $14, but that's including all this the years where it didn't make so much. But take a look at the trend that's happening on this. The only loser was in 2014 where it dropped 17 bucks. Look at last year, $61.33. Now, if I click on any of these years, I can bring a chart up and show what happened. Last year, here's 2015. Look, it actually went up from 1280 up to almost 1340 before falling back down. So you don't have to be in the whole time frame. In fact, for me, again, if I have an option position on it doubles in value, I'm going to get out of at least half of it. 2013. Well, what happened on the year it didn't work? Okay, so it dropped. Then it came back, and it was just starting to gain some momentum, and it fell down again in the last 2 days of that trading period. All of this is available to me and to our software members to go through and look at. All right, the data's in this particular format is not available anywhere else. This is when I talk about it, and I said that Platinum has got a major upgrade. This is what I'm talking about. This wasn't available when we had Option X Platinum. Nowhere near available. Not even a thought to this. But I have the ability to go in and look at stocks like Booking, and then all of a sudden now I say to myself, all right, if this is a potential trade here, what can I do? All right, let's go back to our stock and option tables. Remember, step 1, spot the opportunity. Step 2, create the low risk trade, BKNG. Here we go. I don't need a big move in Booking. Boy, there's a lot of options in this. All right, so let's take a look. This 10-day trade, and it said, remember, if we go back to Money Calendar, what did Money Calendar do? What did it do last year? I mean, it was like crazy. It went up over 50 points. Now, I don't think it's go up 50 points, but it could go 25. It did it 3 of the last 5 years. So let's take a look at the option tables, and let's go 25 points up from 1880. That puts us at 2000 or 1905. Maybe this is the one up. These are September 14th. Excuse me. And thank you, those of you guys that said, hey, you're not looking at the Sep 21s, Tom. Now I am. All right, again, I want to find a target. So my target is going to be where I believe the average price is on the Money Calendar. So if it's 25 points ahead of where we are now, add 25 points to 1880. That gives you 1905. Let's sell the 1905s. Let's back off and let's look at the 18.95s. So we'll go 10 points down. Buy the lower, sell the higher. What's that going to do for us? Let's see what that's going to cost. Right down the middle, and I'm definitely one that loves the limit order on these. $390 to make a possible 610. But this is the most important part. I don't need a big move. I don't need a big move in booking. I don't. I need a small move in booking. I need a 25-point move on a $1,880 stock. All right. I need a less than 1.5% move on this stock. This thing moves 1.5% almost every day, if not more. So there you go. All right. That's the aggressive trade. I'm going to do this one more time with you. So let's go and look at the money calendar one more time. And I want to go back to the month. Let's view the month of September. And let's look at September 12th. Let's look at something tomorrow. And I'm going to hit the power meter twice because that's where I want to go. And look at what pops up at the top. FDX, Federal Express, or FedEx, as we call it now. September 12th to October 23rd. October 23rd, I believe, is a Tuesday. So I'm going to go with the October 19th options because I know they're more liquid than the ones in the following week. I know that from experience. So I'm also looking at FedEx. I'm like, what in the world happened in 2008? Well, the whole market dropped in 2008. Do you guys all remember that? Oil dropped, market started falling, transportation, everything fell. Everything except the VIX and gold fell in 2008. In fact, even gold fell in 2008 too. 2009 wasn't a really big recovery year, but look what happened in 2010, 11, 12, 13, 14, 15, 16, 17. And it's been overall growing for the most part every year. I think we can duplicate the 10.68 move. Let's just call it 10 that happened in 2017, where we started out just below 2015 and we ended up right around 2000 or 225, 215 to 225. 10-point move. Let's take a look at where is FedEx today. All right. Remember, I use the strategy like I'm in the mall. I walk in the mall. The only place I want to go at the mall is to go see the Tesla cars, which I don't really even go see those anymore. But I'll go to the Apple store. Apple's got the big product announcement tomorrow. I have an iPhone 7. Okay. Everybody in my family has a 10. I have the 7. The reason I have the 7 isn't because I'm cheap. It's because it came with a battery case from Apple, and they just don't make them anymore. The Apple battery case, which is really nice, and so it's kind of been, it's like a nice wallet to me. Fits in your pocket. You almost don't even know it's there. And I'm not ready for the 10 yet, but if they got that 10 XS or what they're calling it now, maybe that might, pull me over and upgrade again. Okay, again, I got ahead of myself. FedEx. So we're looking at FedEx. We want to take a look at a chart of FedEx right now. So what I want to do is I'm going to go over here to stocks, charts, stock charts. I already know that I'm expecting FedEx to move higher by 10 points based on what I've seen happening over and over again in the past. Let's see what the chart of FedEx looks like. Well, it took it on the chin back in June, but it's been moving in a higher low and higher high formation. I like where it is right now. I think we can bust out. By the way, this is right around $250. Where's 260 sitting at? 260 is right up here. It's in between two resistance areas. It potentially could come back up, I believe, and be in the area where it was its highs for the year. It also has had good earnings reports that help to at least fundamentally support the stock. So let's take a look and see what we can do with FedEx. So at this point, what I'll do is go to options, and I will create or try to create the low risk trade. I already have one in mind. I'm already thinking 250, 260 spread. Okay. So October 19th, that's what I'm looking at. All right. So the October 19th is what I'm interested in. And this little number right here just gives me a limitation on the stock going. I'm looking at strikes up and down 5% on FedEx. So here we go. Wow, up and down 5% on FedEx doesn't leave me with much, but here's the 250 and here's the 260s. Perfect. This is exactly what I want. So what I'm looking is buy the lower, sell the higher. What's it going to cost me? All right. So that's where the risk graph comes back, and it tells me it's going to cost 408 to make a possible 592. There's your trade. All right. This is a good trade because the 250 calls would have cost $7.33, but by spreading this, I've reduced this almost in half. I would say I've reduced the cost of this trade by 40%. Okay. The other thing too is I don't need it to go up to 265, I think, which would be where the 250 calls would double in value roughly. All I needed to do is get up to around 254. Much less. Much less there. So there's the trade. Yes, sir.
The thing that people are pointing out that we might want to be concerned with on this one is the earnings in 6 days.
Oh, okay. And even better yet, if you're going to trade, you're going to trade through earnings. This is the way to do it, because you know what we're doing? We are cutting out unnecessary risk. We are hedging theta or time. We are hedging volatility, or what we like to call vega. So this is, if you're going to trade through earnings, you know, buying something because you think it's going to go up through earnings, to me, this is the only way to do it. I mean, you could sell naked puts. You know, that's a different strategy that has its rewards and it definitely has its risks. You know, just look at Facebook last earnings, and that'll be enough to let you know the risks of selling puts. But they do have their probabilities to them. I think this is a great way to do it, because you're already putting out what you're willing to lose, what you're willing to make, and it's going to be, in most cases, at least half, if not a whole lot less, depending on what it is you're trading. But yeah, good to point out for sure, Jay. Thank you very much. So, are there any other questions? Jay, do you see any questions out there that people are asking, you know, that seem to be popular questions regarding spreads themselves?
The deltas. What deltas do you want on your spreads?
Okay, so again, this one's a little bit less. You know, deltas are important to me when you are dealing with shorter term options like outright calls or puts. But when you deal with spreads, you are almost neutralizing the deltas to a great extent. What I do is I look at, this is how I do it. I'll take whatever system or strategy you're using. I'm using Money Calendar today. And what I'm doing is I'm taking that average move. In this case, when we see the trend happening here, what's been happening in the last couple of sessions, 10 points is the average move. If we're at $250 roughly, and we're looking for a 10-point move, that puts it at 260. 260 is where I start to create the spread. That's the sell side. Then all I'm doing is I'm backing down to find a spread where I can buy the lower against what that sell side was, and to be able to do it for a risk that I am comfortable with. All right. So that's the trade right there. That's the way I put this together. Again, Money Calendar. And guys, you know, I'm going to jump a little bit ahead here, but next week we're going to go into some of these other buttons I have as we go into learning how to trade like a professional trader. I'm going to show you a couple of other money patterns that we have going on as well. So for this week, if you want to follow me along, we discussed a couple case studies tonight. Okay, the case studies I looked at was BKNG Booking and FedEx. All right, so those are the two. And what I'll do is I will put those together on a nice little PDF file, and I will get them out to you by email so you have those. If you haven't yet, check out the 7-day free trial at www.tomsoptiontools.com, and you can pick whether you want a free trial on Option Trader, Contrarian Trader, Complete Trader, which is everything. We do not have any free trials available for our professional trader. However, next week, I'm going to talk about trading the markets like a professional, and we are opening up because we have some openings on our Pro Tools membership. That is a closed-end membership. We only offer it a couple of times a year. We've only offered it once this year, but we have some openings, and so we are going to open up membership for that. And I'm going to be offering a special Pro Tools offer that's going to save you 65% off. Next week, I'll explain what that is. It is a fantastic offer. It includes not only software, but you get webinar after webinar with us. We do We do webinars. We do, I believe, if I'm not mistaken, we do about 100 hours of webinar, live webinar are included in that. I believe that is the case. A minimum of 100 webinars that are live, that are just looking over our shoulders, me included, as part of this program. I'll talk about that all next week. All right. So, any final thoughts there, Jay, as we look at our last group that actually went on a cruise with us?
Yeah. The only thing that seems to be kind of consistent was, what is your exit? And I've been answering, we look for doubles, and then there's, the time stops and such. So if you wanted to address that real quick, kind of, how do you know when you want to exit?
So, like I did with Coke, like I did with Philip Morris, like I'm trying to do with Merck, and I do with every one of my trading opportunities, I will look to get out of half of my position, whether it is an individual option or spread itself, for double, and I'll hold the remainder until we get to the end of, in this case, the end of that pattern, okay, or where we see we've reached our target price, and that's when I'll take the remainder off. This week, so some of you in the room been around for a little while. You remember we did energy opportunities, and yesterday we had an over 300% gain on one of our XLE spreads. Now we had to hang on to that thing for several months, but we're talking about a trade that cost less than $100. That earlier this week we were able to. It was trading above 3 point. It was trading at almost 3.4. So it was a really nice move. That was more of a patience is a virtue trade, but that was one of 3 that we did in the oil and energy markets. But yeah, it really is all about, get out of half, at least half, when you get a double. That way you're playing with house money afterwards. You got somebody else's money, not your own. And it just makes it a lot easier for you to stick in and hang into those trades that are still coming. All right.
Thanks. That wraps it from our end.
Awesome. Okay, guys. Well, I'll have emails to you here later tonight with the recording. I will have the PDF file for you, along with any other notes that I have on the trade case studies we did. Next week, we're going to have a lot of fun. We're going to actually, I'm actually going to do a top-down approach for you, as I do with our live professional group, and I'll show you exactly how we do that and how we spot opportunities. So that's going to be what we're going to do next week. Have a great rest of your week, and I'll see you soon. All right. Good night, everybody.